My motto in life has always been to try to be as brutally honest as I can. I don't think that competition necessarily makes the home product better. It's a risk. It's there.
We throw out democratization of wealth management, right? And to me, democratization of wealth management, if I really break it down, it's about the fact that the trading apps have made stock markets arguably more approachable. We've seen the advent of robo over the last decade or so, and that's been a nice roller coaster ride. A few questions to you, right? And I'll pose the questions up front so that you can have one go at it. One is, have you genuinely seen democratization, whether they're large banks or smaller banks? I think everybody is looking at wealth with, I guess, a renewed impetus. Joining me on the couch is Roger Rouhana. Roger is the CEO of Alpheya. Are you seeing two types of banks? One who are saying, yes, that's the way forward and we will go open architecture and we will improve our asset management capability, because at the end of the day, we can improve our asset. Or are there others who are saying, no, we're going to keep still flogging what we produce, right? And yeah, we'll give a little bit more importance to the wealth management guys by giving them an app and a few more advisors.
Was that a dumb question?
If you could answer this honestly, what is the biggest challenge that you're facing in terms of locking in the banks, right, into your philosophy, into your platform, and becoming your customers? So welcome to today's episode of Couchonomics with Arjun. Joining me on the couch is Roger Rouhana. Roger is the CEO of Alpheya, which is, in his words, and he'll explain this to us a lot more, a wealth tech platform, right? And I hope I've got that bit right, but he'll correct me. Roger, welcome to the couch.
Thank you for having me.
Right. We had a nice little chat before we actually started this discussion or started this podcast. So Roger, I think for the listeners, it would be very useful if you could sort of, if I may say, tell us a little bit more about what Alpheya is, the origins of Alpheya, how long have you guys been in business, so on and so forth.
Absolutely. The gospel. So Alpheya unlocks growth for financial institutions and prosperity for their investors through our next-gen wealth and trading platform. At the heart of it, that's our purpose. That's what we do. We're B2B and B2B2C. We were incorporated in ADGM last year, in June of last year. So we celebrated our first year last month.
Congratulations.
Thank you very much. Our two anchor investors are Bank of New York, so the oldest bank in the US, celebrated its 240th year this year, and Lunette, one of the largest alternative asset managers in the world. They manage something like $100 billion. And it's with them that we raised $300 million to really, as a priority, go after the MENA region and become the core infrastructure and the orchestrator when it comes to wealth management infrastructure.
So, I was going to hold back for this question for a while, for a bit later, but let me just ask, why choose the MENA region?
It's a very good question. It's actually very straightforward. Large and growing TAM. You have $4.5 trillion of personal financial assets here. Extremely timely client needs. There hasn't been a bank who I've spoken to yet who has closed the door to us. And unmet needs in that when you look at the offering in the region, it's there's a real opportunity.
Okay. So take a step back. I think it's worth us just taking a bit of a macro view. Talk a little bit about what's actually happening in the global wealth and asset management scene, in the sense, how is it evolving? What are sort of the trends of change? And I don't mean the classical trends such as, this technology entering. Yes, we all know that. But sort of give us a bit of a flavor on what's actually happening in global wealth. Because I read this morning that the 1% of America has got even richer. But on that note, I opened the platform for you to tell us what's happening in the world of wealth and asset management.
Yeah, I mean, look, I'm going to cover some more generic trends and maybe some that.
And please, and then dive down into this region.
Absolutely. So a couple of things. First of all, wealth management, it's one of the most attractive verticals in the financial space. It's growing, right? It's grown at like 10 to 12% pretty steadily over the past 10 years. It's going to grow at the same pace over the coming 10 years. It's got a high margin, right? Like 30% margin in developed markets. It's capital light versus other businesses. So it's a pretty attractive business to be in, right? And as a consequence of that, everyone is trying to grow in that business. And the way you're seeing that growth is through consolidation. So, the largest players are getting larger. The middle players are kind of being left behind. And there's a real arms race in wealth management, right? And you're seeing this globally. From a consumer perspective, you're seeing a few things, right? So first of all, you're seeing what we'll call maybe generically, right, an intergenerational transfer of wealth. Baby boomers and above are leaving their money to a younger generation, a digital savvy generation, a generation that's on Instagram, a generation that's on social media, a generation that has very different expectations from what they want out of their wealth manager than, well, their predecessors, right? Another trend that we're seeing is the barbell effect when it comes to asset classes, right? So you're seeing on the one side the rise of ETFs, right? Everyone knows about it, but I mean it's pretty extreme, and it's been a massive force in the markets at the detriment of mutual funds. And on the other, so that's like on the low cost side, and on the other side, you're seeing the rise of alternatives. Where everyone's talking about credit funds, private equity, et cetera. Last year was not a great year for those asset classes in terms of funding, but it is established. This asset class broadly is establishing itself as a reference, right? And clients are asking for it. Another interesting trend that we should talk about is the rise of technology. And it's interesting from an industry perspective because it basically increases fixed costs, right? And that technology, those technology sort of like investments that banks, asset managers are having to invest in, they're driven by, well, regulatory needs, but they're also driven by the demands of the consumer, which want to have a much more Amazon-like experience. Another, I think, trend that I find particularly interesting is the balkanization of wealth management. If you think about it, it was one of the most global sort of like sectors of finance, right? Offshore accounts everywhere. It's a great sector in general because, well, investment ideas are global. They touch several classes, several sectors. It's such a creative space, right? But where you've seen retail banks containerized geographically over, in the past decade after the GFC, you're seeing much more of that phenomenon now where, well, assets are getting closer to where the residents are or to where the nationals are. And that's driven mostly by geopolitics, right? Which is probably a good sort of like dovetails well into what we're seeing here in the region.
I was going to ask you, right?
Right.
So dovetails well. But what's happening in the region, which is different, or is it further accentuating one of the some of the trends that you've mentioned?
So I'd say that there is an awakening in the GCC. Let's focus on the GCC for our sake. That, well, wealth is actually a very interesting part of the business, and that over the past 20 years, it's the business that's received the less investments, right? Because or the less investments towards tech and ops, because you know what, the advisor meets the client twice a year for coffee. A model used to work quite well, and that's shifting. That's the first reason. The second reason is because also foreign banks are also upping their game, right? And so if you take the UAE as an example, you're going to have, well, the mega nationals, right? The FABs, the NBDs, the ADCBs, the Mashreks in the sort of like the top 10. But you're also going to have Citi, HSBC, Stanchart competing extremely aggressively for that market. And they come with their global practices and their pretty big investment arms, investment means. Mm-hmm. So the race is also very much on here, and it is the last digital frontier from a bank perspective. You know, they've upped their game in retail banking. They've invested in their corporate banks. The ones who wanted to do things seriously in capital markets have invested in capital markets. So, you know, every board is now asking, okay, what is going to happen to our wealth management business? Right? That's one. The second one, which was the reason why we dovetailed into the region, is, well, with the geopolitics globally, what you're seeing is that there's a real card to play here, right? And I'm going to take a couple of examples, and I don't like to be like a cheap geopolitical commentator, because that's like a national sports, especially as an Arab. We love to talk about that. But there are truths, and we are seeing them, right? So, for example, Hong Kong as a financial center has suffered from sort of like the China consolidation. Similarly to that, so you've seen in a first instance a lot of flows going from Hong Kong to Singapore.
Massive flows.
And
Singapore has just emerged as the center.
Absolutely. Mm-hmm. And actually, when you look at like PFAs, personal financial assets, I might use that again later. Singapore, the UAE, pretty similar as of like 2 years ago, 3 years ago. That's when, right? But those were sort of like, I see those as flows that sort of were kind of panic flows. What you're now seeing, because people now ask themselves, well, Singapore, it's also very close to China, right? So people are now thinking about their diversification strategies. So you're going to have a leg in Singapore, but like, where's your other leg going to be? And you're probably also going to want to have 3 legs, right? Like, especially for certain amounts. So where do you go? Well, you have the historic centers, let's say Switzerland, the UK, the US. Well, Switzerland's largest bank has failed last year, and the banking secrecy is gone. So safety is not really there as like it doesn't scream safety anymore. Of course, Switzerland has fantastic banks, fantastic talent, fantastic offering. It has 100 years of know-how, right? But now there's a noise. That's number one. You think about the UK, you think about the US. When you look at what happened with, well, first thing, the safety of the banks there, we had at least 2 of the top 20 banks in the US that failed in the past 2 years, right? That's number one. And then number two, what's happened with the freeze of Russian assets has also had pretty meaningful repercussions on the way people think. Because it's not about like, was it a good decision or a bad decision to freeze those assets? It's about, well, it's setting a precedent, right? That if I am not a resident of those countries and I come from a country with whom there are disagreements, well, are my assets safe? And that's where there's a real opportunity here, because stability, financial stability, political stability, right? And openness. And of course, all the what we hear all the time around the quality of life, safety, etc. Right? But I really think that like the drivers of flows coming here are going to be around financial stability and political stability.
Okay.
Right.
So you've left me so many doors to open. As I said, so many doors open. Let me try and go into these rapidly and sort of explore that, right? So the first one, which I took notice to, and I completely agree with you, is what I call the decorrelation of digital savviness and being rich, right? So classically, and apologies to people out there, you were rich, you were digitally unsavvy, if that's the word. You needed someone to call you or handhold you, and that was the model, right? Now you have young boys and girls or younger, or even the older generation who are way more digitally savvy, and they don't mind the red carpet treatment, but they don't necessarily need to be wheeled into the best looking branch at your bank, right? How do you think banks who for decades have operated in a particular model for a very, very small percentage of people with very, very large corpuses of amount of money, how do they adapt to this sort of world where it's phygital? There is the physical element that will not go away. I don't see it in the foreseeable future, but there's a lot more technology, right? The challenge is not necessarily technology. That's available. The players like you and some of your peers who are there. What is the big challenge for these banks?
What peers?
Okay. But what challenges do these banks really, really face in the near term to address this?
Yeah, and so I'd like to answer sort of like the question from two sides, because obviously there's sort of like change driving the tech investments, but there's also the opportunity to serve a much broader set segment of players, right? Yes. So we'll get to that in a second.
Yep.
And it's very interesting because like we ran a lot of interviews with a lot of high net worth individuals, and like the common theme that you get is, I still want to talk to someone, but if my bank is not able to have a decent app, how can I trust my bank? That's sort of like, the gist of it.
Okay.
And so what they want to be able to do is do a bunch of self-serve, right? Like the grail is going to be subscribing to a private equity fund on your phone, right? If you're not accredited sort of like subscriber. Mm-hmm. They want to be able to get access to insights, research that's tailored to them, right, in a digestible fashion, right? They want to be exposed to ideas, and they want a really good experience, like an app that we would all want, right? They are no different. But of course, at the same time, the classics of sophisticated investment solutions, thought through portfolio analysis, scenario analysis, all of those stay there. The delivery needs to change dramatically, right? You were asking what the impediments to...
No, but what are the challenges? So how do banks address this issue, right? It's one thing to say, yes, we're going to invest more in technology.
So that's where I disagree a little bit with you on, well, you have players out there. Well, actually, you don't have that many players out there. That's what I would. So if you think about competition broadly, and you know the space pretty well, when you look at really core wealth management providers, not sort of like very detailed robo that cater to like the masses. Most of those firms. So the youngest I can think of is 25 years old. Mm-hmm. Right? And then like the Swiss big boys or the American big boys, they're like 40 years old, right? Like what I consider our biggest competitor, they were founded in 1985. Mm-hmm. Right? And the other guys, they were founded in 1984. Mm-hmm. So those people, and by the way, like great companies, when they were founded with the idea that to run a private bank, you need a ledger in the back. Mm-hmm. Right? And then the rest is going to be the advisor. And of course, over time, they tried to invest, etc. But the core never changed. And even some of those players, when they say that they have a cloud solution, it's the mainframe on the cloud. So
just going to cloud doesn't mean you've changed everything.
Exactly. Yeah. So you have those legacy sort of like back office players, right? So that don't really fit the bill, that don't help you in your transformation. That's sort of like one set of solutions. Then you have attackers that are going to be more focused in sort of like what they offer. Mm-hmm. So you're going to have financial planning firms, right? You're going to have a brokerage sort of like technology firm. You're going to have a portfolio construction technology firm. Mm-hmm. You have to stitch all of that together. Mm-hmm. But the stitching is where it breaks, right? And even those players, they don't offer you the front-end experience that you really need. Well, but like, sort of like, if if a player like me didn't exist, I'd probably try to stitch together things. That costs a lot of money. That creates a lot of risks. You need a great team to do it. So that's the whole point of our contention, which is actually there's no real player that offers you a one-stop shop end-to-end that caters to all your needs. And what I mean by that is it caters from a capability perspective to everything you need. Great front ends for your investors, great front ends for your RMs, with all the analytics around productivity that you need. Great applications, right? Onboarding, financial planning, brokerage, portfolio construction, performance analytics, right? So like a one-stop shop for capabilities that caters to all your business models. You touched upon it a little bit, right? But like the way we look at wealth management, it's self-directed trading, which is the bulk of the region here. It is robo-advisory, right? Which is nascent. We can talk about it in a second. It is advisory, and it is discretionary portfolio management, right? Which are really the two parts where private banks make their money.
So you get the DPM stuff, and right.
Absolutely.
Okay, so switching from that, a couple of questions to ask, right? So the first one, and again, I might have got this completely wrong, but what's the harm of asking a dumb question? That's my I guess that's my prerogative here. So for a number of banks over the years that I've actually seen, is wealth management has been nothing more than a channel for their asset management function.
Yes.
Right? So it's kind of like the distant second cousin. There's not much attention paid. We produce all these asset management, these so-called portfolios, and we use wealth management to flog them in the market, and we make money. All right?
Right.
Now you are basically turning the thing on its head, right? And you're saying, by the way, what you really are is in wealth management. Asset management is a very key part of you maximizing your financial value. But if you really want to be the best wealth manager, you've got to adopt a little bit of open architecture. You've got to go beyond your own, your own asset management capability. Here's a question for you. I'm assuming that's creating a lot of tension within these institutions, right? How do you see banks addressing this? Are you seeing two types of banks? One who are saying, yes, that's the way forward, and we will go open architecture, and we will improve our asset management capability, because at the end of the day, we can improve our assets. Or are there others who are saying, no, we're going to keep still flogging what we produce, right? And yeah, we'll give a little bit more importance to the wealth management guys by giving them an app and a few more advisors. So how do you see the market? Is it as polar as I've made it? Because I have this bad habit of kind of turning the world into black and white. Or what are you experiencing?
Was that a dumb question?
Well, I don't know, man. It's a question that I think long and hard about every day.
I like the framing of this industry of wealth and asset management being split in two. You have manufacturing and you have distribution.
Agree.
Right? What is very true in what you said, and it's more particular in Saudi, right? Where investment arms are separate from the banks, like legal entities, etc., management teams. And in Saudi in particular, practically by construct, like the wealth management doesn't really exist. It is exactly as you said, a bunch of asset managers creating products and, excuse me for the expression, shoving them down the throats of people. Good products, attractive returns. You are right that even globally, right? Even like, I bank with JP Morgan in the US. When they call me, they try to push JP Morgan. They happen to be an extremely competent, large asset manager. So it's a thing. What you're describing is very right. And I'd say there are a couple of things, and I don't think that they are antithetical. Because I don't, so you're going to have, everyone has the realization that even to sell their prop funds, they need to work on distribution.
They do.
And that's like a no-brainer. Then you have the second question, which is, when I come and I tell them, look, I have a marketplace. You're going to be able to access structured notes from third parties, alternative assets from third parties, digital assets from digital assets, they never have them, but digital assets. you have some people that are like, but wait, so you're going to take flows away from my products. But when you talk to the head of private banking or to the CEO, they appreciate that it's happening.
Agree.
Right? And actually, what they are seeing themselves is when a client asks for a product and it's not there, they go elsewhere. Right? So it becomes a matter of, okay, we're going to try to push our products, but if you want to retain some folks, you need to have a Goldman fund on there, an Apollo fund on there. Like it's a necessity. And I do think that people are getting there, right? But yeah, look, it's something that you mentioned earlier. The rise of alternative platforms is awakening them to that, right? Because when you have an attacker that does something as simple as offering international equities, well, although you don't make any money on that business, it takes flows away from them, right? International equities in a self-trading fashion. So people are getting there.
So you're getting that, and I'll tell you something. So this is a show for you. It's not for me. Here's kind of my hypothesis, or here's my 2 cents worth. The way I see it here is, there is a fundamental shift from being a product-focused organization to being a customer-centric, I hate the word customer-centric, sorry, a customer-focused business. The positive of this is as follows. So the positive here is that it will trigger 2 or 3 things. A, it will make your manufacturing function better, because in effect, they will have to compete, right? And there is no reason why they cannot compete better, because as you said, they make good products and they can make even better products. Secondly, you will actually find another avenue of making money, because if you don't, someone else will, right? Because the need doesn't go away. All that happens is the need goes to someone else. And I think thirdly, and most importantly, is that at the end of the day, and I think you summed it up very well, everybody's coming to the party, right? The number of customers are finite, retention is going to be critical, and retention comes at a cost. And you rather take that cost up front by actually accepting the fact that there is a wider bouquet of offerings that you need to offer. And over a period of time, as you get competitive, maybe your share of wallet increases. But I don't think what you do is not offer somebody something, right?
That's exactly right. I agree with everything you said, except with the first point.
Go on.
Look, my motto in life has always been to try to be as brutally honest as I can. And I don't think that competition necessarily makes the home product the home product better. It's a risk. It's there. It may make it better. It may make it worse. But it's just there. And so. Where you're spot on, I really think, and it's global, it's across every sector. It's the person that owns the client that wins. It's the company that owns the client that wins. And I still find it incomprehensible why Instagram never spoke to me, right? Sells me shampoo, sells me swim trunks, knows my needs spectacularly well and spectacularly better than my bank, who can ask me any question that they want, who's supposed to manage my financial future and the financial future of my children. This is an anomaly that we need to fix. That's sort of like why we're in this business. It doesn't make any sense. And like on the message of hope for financial institutions, you are right. The number of people is finite. But what you can do with their pool of assets is actually untapped.
Oh, no, totally. I think that the needs are much wider than one understands. And I think, you've seen the rise of alternative investments, right? People are investing in everything from, fractionalized cars to wine vintages to, homes in different parts of the world and so on and so forth. Let me switch something again. You mentioned something up front. younger people have more money. There's more technology, right? And like every good consultant, right, we throw out democratization of wealth management, right?
Right.
And to me, democratization of wealth management, if I really break it down, it's about the fact that the trading apps have made stock markets arguably more approachable, right? We've seen the advent of robo over the last decade or so, and that's been a nice roller coaster ride. Few questions to you, right? And I'll pose the questions up front so that you can have one go at it. One is, have you genuinely seen democratization, right? Do you really think all this technology has genuinely democratized? Second question to you is, has democratization brought in some inherent risks that none of us thought through? Because in effect, we've left children to play in play fields where they actually don't know entirely where the boundaries are, right? There are so many stories that I know where people have, wasting money on NFTs was a great idea, right? When NFTs first came around. I have nothing against NFTs, but I think people were mindlessly investing in them because they had no clue what they were investing in, right? And the same can be talked about stocks, to be honest with you, right? So it's not just about a crypto thing. I think it's just generally. Let's answer those two, and then I really want to talk a little bit about robo with you separately. So democratization, have you really seen it?
So let's start with the latter, the risk. People like adrenaline. People have a tendency, we see it in gambling, we see it in some meaningful parts of crypto, right? To sometimes delude themselves into thinking that this time is going to be different. I can win, the others can't. Well, it's part of human nature. It's a mix of greed and a bunch of behavioral biases. So certainly, right, what we've seen over the past 3 years, it's calmed down now, but like it's the advent of the day trader. And what's facilitated that? It's a bunch of platforms, and it's a bunch of instruments, right? Like I played a little bit with, triple leveraged negative ETFs on like the S&P 500. It's like the easiest thing to buy, right? And if the S&P goes up 1%, you go down 3%. It's very easy to get like sucked into it. And we talk about gamification. The whole thing is a game in itself. You don't need to gamify it. Like, it's a game. Buying, selling, looking at the result, it's a game. And you're absolutely right that in particular, when you enable things like margin lending and like you don't need to wait for your cash to come in, you lose yourself. So it's a risk. That's the negative. Now, talking about the positives, right? We are offering people way more avenues to manage and grow their prosperity than 20 years ago, where basically you could buy a house, right? Well. And in a world where, population is not necessarily increasing, maybe real estate is not the asset class of the future. So that's number one. Number two, we're also, when we talk about democratizing, it's a few things. It's access to financial assets in itself, right? So it is having those apps. That's happening. It is access to instruments, right? Some more than local equities, international equities, local fixed income. That's slowly happening. The region is very late to the game, right? And when it's enabled, the fees are extremely high, but we're going to get there. It is access to advice, which is like the tailwind into robo. And where technology is very helpful, because you have anyone that's less than $5 million of worth is not profitable to a bank. In terms of like, I'm going to advise them, I'm going to take my advisor's time, right, and manage that relationship. They're not profitable relationships in the way things are today. So what do? You bring in tech. You can do financial planning in a very easy way. You can pick a portfolio in a very simple way. And most people, they don't know the Markowitz limit, or like they don't care. They have some money aside and they just want to grow it. Right? And they're not thinking about what's the fastest. A lot of people, they just have, those $50,000 aside And there's a large pool of people, and they just want to know something to do with it. And like Sarwa has been great at going after those people. There are even a lot of people like me, right, that have maybe a bit more than 50, right? But they're in cash because they don't have the time. They don't trust their advisors, right? Because like every time I've spoken to one, he's tried to sell me some like really, really doubtful product that's extremely expensive, right? But I would like to go through some thought process with potentially either a good advisor or a machine, right? That helps me sort of like direct me. And also where I don't have to do 10 things to get there. I do 2 clicks and I get there, right? So yeah, democratization is happening slowly. And I do think that tech is the unlock, because going after that market only happens from a financial, from a economic returns perspective. From a bank, you need tech to go there.
Mm-hmm. Okay, let's switch to robo.
Yeah.
And I think, I'll show you my age because how old I am. So I've been around since the early days of the advent of the word robo when it sort of came around. And obviously, just for the sake of the show, I don't take names of them. Most of them were in the US.
Yes.
Right. And we saw this euphoric sort of euphoria around, robo-advisory. Now you can actually get advice. There's a tool out there, and this is early stage AI. I'm sure there was some level of machine learning and AI being used even at that stage, who can, looking at your risk parameters, asking you 25 to 50 questions, come up with a portfolio, and then help build your portfolio, and you executed your portfolio, and all of a sudden you felt more than just a day trader, right? So you were not just buying the Apple stock or whatever else. You were getting a whole portfolio, which could involve everything from ETFs to whatever else, right? We then started seeing that, these robos were growing, but they were not actually leaping over. Some of the banks then realized that, hey, this is a great opportunity to buy into these robos because they're unlocking an entirely new market segment for us, and the cost of customer acquisition is a lot lower. So why don't we actually go down and do that? Then started this very interesting dialogue that, hey, now robo needs assisted robo, because after a certain level of exposure, people are saying we need someone on the other side, some sort of a human contact, whether that's on the phone or any other format, right? And sort of we're somewhere in that cycle right now. Some robos got bought out, others did not, and some have independently, I guess, got to a certain stage. I get the sense that in this region, we're having very similar conversations right now, right? So a number of the banks, and obviously I work for a management consulting firm. I work in the world of fintech and financial services. So I'm speaking to a number of them, and they're having what I call quasi-robo conversations.
Yeah.
Right?
Yeah.
Your views on robo, what's good, what's not so good? What sort of version of robo do you see coming to fore in this part of the world? And where do you think is the delta as we sit today?
Yeah. A couple of things. There's a lot to untangle in there.
Unfortunately, having me as the guy on the other side.
So look, let's. I remember. I remember when Betterment came out, and that was really for me. It's like the pioneer, right?
Mm-hmm.
And I looked at this, and actually. Stein, I think it's Jonathan Stein. So the co-founder came to business school like 2 years after founding it. And I was in awe about what it was. It was such a great idea. And I asked him, like, dude, why aren't banks doing this? Right? It's like, they have the customers, they have the funds. And he was like, honestly, I don't have an answer for you, right? And then Betterment, I think robo for a while, to a lesser extent, went through the craze of like that we saw for crypto, that we're seeing for AI. Betterment today they probably manage $60 billion of assets, right? But did they meet their economic dreams? No. It does raise questions by itself on the business model, right? So the way I think about robo is, for a bank, it's part of the toolkit, right? And actually. To be honest, the way we deal with robo is we throw it in as part of the package. Like I don't price robo separately, because if you are a bank and you have a private banking franchise, the buck is in private banking. if you have a bank and you have a retail franchise, and like you don't have great tech capabilities, enable self-directed trading first, right? Robo comes on top. It's part of the arsenal of business models that go from self-directed, robo-advisory, DPM. You'll make way more charging for advisory and DPM than you will make for robo in terms of like, price times volume. That's my perspective. I do think that like you have great players in the market, really sort of like, carrying the cross, right? Going through the motions, fighting to, I think a couple of them are actually sustainable. I also see a lot of people that like, I've seen a lot of like, quote unquote, rinky-dinky solutions that don't really take the thing seriously. And they think that with 10 people, you're just going to,
So you make a very good point. Sorry to interrupt you. Rinky-dinky and robo. Do you see players on fintech specifically or wealth techs who are coming in the robo space? Do you think there is a space in this market for what I call a B2C robo player? Or should they all be B2B2C and work through the banks?
Well, you have a couple, right? And
the performances, I don't want to dwell into it because I know some of them very well, and I know the numbers. They're okay. They're average.
Okay. Yeah.
They're average.
Yeah.
But I don't think that they're going to shoot.
So is Betterment. So is like Drive Wealth. It's fintech in banking. It's kind of always the same story with a couple of exceptions, right? Like you don't have the trust that a bank has. You don't own the captive client that a bank has. And finance is probably the place like where there is the most inertia to move a client from a place to another. Yeah. Governments have tried, like, in the UK, if you look at the concentration of the top 4 banks 20 years ago to today, it's moved by 2 points. It's still above 80%. And governments have tried to break the banks down.
And that's
it's everywhere. Yeah. So I think it's great that there are players that are innovating in a B2C fashion. We've made another bet at Alpheya, obviously. We think that the big opportunity, it's enhancing and helping banks go through this transformation.
So I'm not endorsing your model. This show is not about endorsing your model, but for whatever it's worth, and I think what I say is worthless, but here's my view. I think for me, robo in this part of the world, your B2C is your showroom, right? It's a great place to innovate and learn from if you can afford to. But I think the real opportunity is the B2B or a B2B2C model, because I do think that with everything coming around, which is open banking, open finance, and the fact that you just drew these lines, which is trading, robo, DPM, advisory, it's all integrated. And funnily enough, the customer in the top moves around.
Absolutely.
Right? It's not, those days have gone where this customer was only serviced this way and this customer only went. There could be a super rich guy who wants to just go onto your trading app and transact at Apple at 3 a.m. in the morning because he feels like doing it.
Absolutely.
And at the same time, he wants to be able to access a yacht, right, for the sake of argument. The other thing is, I do think, asset management plays an increasing role, right? Especially if you want to start making the big margins because you want to be the product manufacturer who distributes. I think insurance companies set the stream. For you, just for a little bit of my knowledge, I used to actually work with AXA. So I used to work with AXA investment managers. And I remember the day where AXA as an insurance company had to then go open architecture because we realized that only selling AXA investment management products was not the way forward. We would want to bring it out. In any case, this is again not about me. So switching from robo, right? I'm gonna take this forward in terms of what Alpheya, but I'm gonna frame the question in a slightly different way. Now, I hear a lot of the rhetoric I hear is as follows. Roger is unique to Arjun, right? Not just because we're at a different age, but there are lots of uniquenesses about us, right? And classically, wealth management offerings have been incredibly generic. Everybody's kind of forced into 3 or 4 buckets, right? You're either completely risk averse or a risk taker. The fact is, it's more and more like a customized suit, right? If you're going into the world of hyper customization, right, and then AI allows you to do so, do you think it is becoming more and more critical for successful wealth management platforms, robo or otherwise, to be able to do that hyper personalization? And is that something that you as a platform think is critical, or you think that, hey, this is just yet another, few people who just want to flog AI.
Right.
And so therefore they're saying we need to have 4,000 personas. So tell me where you sit on this.
Yeah. So I think about hyper customization and hyper personalization as two slightly different things.
Sure.
Right. So hyper customization is like sort of like portfolio related. Hyper personalization is how you deal with the individual.
I'm talking about the former. So customization. So forget the personalization side. Let's talk about customization.
Yeah. So I am more interested personally in sort of the role I play in hyper personalization, and I'll come to it in a second.
Okay.
Because for a couple of reasons. When it comes to hyper customization, most people, they are not finance savvy, right? So let's just, either you have either you're in the bracket where you have an advisor and he customizes everything for you, he takes you through it, and he keeps this illusion that you're going to be able to beat the markets, and so that justifies his fees, right? And hopefully you do. Or you don't have that advisor, right? And in that case, either you're financially savvy or you're not. Most people, the population, for very good reasons, they are not. The average person, do they really know the difference between a stock and a bond? Let alone private equity, let alone ETF. What's driven ETFs? It was easy and it was cheap.
Simple, yeah,
right?
Simple and cheap, yeah.
What's driven alternative assets? Because it's pushed by a lot of people, because the margins are very high, and there's all the infrastructure that. So when it comes to hyper customization, do I think you can do better than the 5 portfolios that correspond to the 5 archetypes? Yes. Do I think it's transformational for the masses? I'm not sure. Do I think, sorry, I'm asking myself, I hate doing this where I ask myself questions I answer, but do I think that soon enough you'll be able to tailor those portfolios so that they cater to your needs, make that exclude defense stocks from that portfolio, or give me exposure to Japan? We'll be able to do that, I think, in the coming 3-4 years through AI, because otherwise, it's just not economical to do it, right? But in the meantime, I think that what really matters, because we're toggling between high net worth and masses, but I think right now we're talking for the masses, the mass affluent and affluent plus. I think what really matters is hyper-personalization. And what does that mean? How do I think about it? And how does that tie to AI, right? And by the way, I'm not talking about generative AI, machine learning. Mm-hmm. Right? So there's 3 components of how we think about hyper-personalization. Next best conversation, next best offer, next best action. Mm. And these 3, with relatively simple linear correlations, you can get to an offering that's materially better than what you have today, which today you have nothing, right? So let's take an example. Next best conversation. All right, NASDAQ fell 6%, 5% over the past 3 days. You're exposed to the NASDAQ. What are the options? I don't do anything as a bank. Option 2, I call you and I tell you not to sell. Because it's fine, I know that you have the guts for it. And I know that you wanted to be notified. Option 3, I call you, I know that you're you're pro-risk, and tell you, hey, there's a buying opportunity. Right? And option number 4, I should have started with that one, I call you just to keep you in the loop. Right? I'm saying calling. I send you an email, I could be your advisor, or I could be a robo, right? That's so that's next best conversation. That's pretty cool. You don't get that today. You own Tesla. Tesla dropped 12%. What do you do? I'll talk about how what we're doing with generative AI to top that sort of conversation. Next best action is, it's the classic Netflix. People like you have liked Tesla. or US mutual fund X, right? Well, that's pretty cool. You're sitting on your app, right? You have some cash, you get this push. The propensity of you to invest is materially higher if you get this push than if you don't get it, right? And you'll be happy that your cash is not sitting in a 0% account. Next best action is, it's more operational. It's, hey, time to rebalance your portfolio, right? If you didn't put it as an automatic feature. So all those things, we can do them today, right? You don't see them. I bet you, I mean, maybe you'll tell me actually you get it, but like, I don't think you get any of those today, you yourself in your...
I'm just a bad example of a person because I manage everything myself.
Right.
So I don't use any advisory. I'm on like half a dozen platforms.
But you should not be on an advisory. It should be part of your app.
Yeah, it is. The apps keep prompting me, but I've got so many apps that I've even lost count of what all I keep doing. I'm just foolish. So I'm not your target customer. I got onto one of these apps which is known for its social investing, and 4 months later I realized I had $150,000 already on it because I just went on I just enjoyed it, and then I realized that is it the best or the worst thing? Well, so far so good, but it isn't. So Roger, conscious time, right? A couple of questions, and I want to circle back to Alpheya, right? You mentioned that Alpheya is a platform which offers a whole host of things vertically and horizontally integrated, right? We've gone through this, or we're going through this, I guess, overall trend in financial services where we went from a world where everything was very, very monolithic, right? You were subservient to your technology providers because legacy basically ruled innovation. We then went into what consulting firms, other firms said, the great unbundling, right? Or some called it atomization, right? We're now apparently in the rebundling space, right? But rebundling is actually happening in a couple of different ways, right? It's either happening through orchestration layers, right? Or it is happening through certain banks and financial institutions who've upped their own game. So they're stitching stuff together, whether that increases complexity or not, right? Where do you fit with someone as Alpheya who offers everything? So first question is, are you a very modular platform, which means can people beg, borrow, and lend stuff that they want from you without having to buy the whole platform and then stitch it together with some legacy and some other players? Okay. And secondly, if I just may wrap that question at the same time, because it's very interesting, is, and if you could answer this honestly, what is the biggest challenge that you're facing in terms of locking in the banks into your philosophy, into your platform, and becoming your customers? Sorry, again, there's a lot to unpack. But
no, but those are great questions, and it's what keeps us busy, right? So let's talk about modularity for a second. I have two answers for you, right? Where I'm very happy to be modular is coming on top of those ledgers, right? Ledger migration is the most painful thing you can inflict on your organization. Hands down.
Agreed.
Hands down. It takes longer, it's more expensive. So we are happy, right, when we talk to a client, we actually are proactive to tell them, look, you know what, don't take our ledger. We'll come in on whatever you're using today. If it works today, it'll work with us. We just, quote unquote, have to integrate. It's a lot of work, right? That is the one where I'm happy, right, to modularize. And we, of course, have an interop layer, right? To the second question, to the second part of modularity. Well, we get that question all the time, and my answer is always, what are you trying to achieve? Tell me the tool that you have that you want to integrate in our environment, and we'll look at it, and of course we'll try to make it work. But like, why would you sustain 2 licenses? Why would you sustain 2 stacks? If someone tells me I have my CRM in Microsoft Dynamics, like I want to integrate with you, 100%, makes a lot of sense. My fees are there, 100%. If someone tells me I have this, which I haven't heard yet, but I have this financial planning tool that I like, and that I want to integrate in your stack, I'll be like, look, honestly, we can try, but I'm pretty sure that like our solution is going to be, if not better, I'm sure it's better, but like at par, and you won't have to think about integrating them and maintaining those two stacks, right?
Yeah, but what if I actually had my own trading app, right? So my own trading infrastructure and stack, right? And let's assume
that's very easy.
Okay,
absolutely.
Let's assume I have an existing robo player already, and that I've been using for 2 years. Let's assume I have an alternative asset platform that I've been using.
Absolutely. Those three examples are completely modular. Okay. And I'm going to tell you, if we were in Switzerland, right, I'd have a much more elaborate conversation around modularity, because players there, you know, they've been at it for a while in their digital journey. What we see here is that there are a couple of players that are ahead. I'm not going to name them. I think they know who they are. I think you know who they are. Like in the whole GCC, there's like 2 or 3. But most of the others, like, yeah, they have a trading app. It's not great.
No.
Right? It's pretty poor.
Even the ones who are ahead, I can show you the apps. You know, because they're built on legacy infrastructure. There's a lot of patchwork which has been done.
There's patchwork, like also it's clunky, like it's not nice, like you're not happy to be there.
I have banks which are offering 3 apps with 3 different types of trading. Right.
So that is part of our fight, by the way. It's like, stop fragmenting the experience for your customers. And that is something that we see a lot, by the way, in Saudi, where every time there's a new feature, there's a new app. And you're like, guys, people are actually in the process of consolidating, but I'm going to tell you, it's not their fault. Why? Let's talk about the why. Trading app. Who provides a trading app for those institutions? It's another broker.
Well, if you white label it, yeah.
Most of them white label it. Most of the market, and for very good reasons.
There's all kinds of regulatory challenges also.
Sure. Absolutely. So for very good reasons. But like, from a tech perspective, right? I mean, the broker's job is not to have a great app, right? And the broker's job is not to be a robo. So like, you know, already having these 2 experiences separate is difficult. But what we do, the way we tackle this problem is, we do work with a broker. We're not a broker, right? We have a partnership. It's going to be announced soon. But like what we think is the best broker in the region and actually globally. But the way we embed our investor facing capabilities in our clients' portal is through SDKs. So we don't give them like a web app. So that's the worst experience for me. You know, you go in your, you go into your banking app, and then you go in wealth, and then there's like a sub app that opens. It's pretty clunky. We give them SDK, so we give them the designs for reference, and we give them the pieces of the code. Right, and they just embed them. It takes 3 months. It's seamless, right? But then you can customize it the way you want, right?
But then what you've just said is, so you're very open to being modular.
Yes.
So what do you mean by saying you're not being open to modular?
I always ask the question. So we are open, but I always ask the question: what are you trying to achieve?
Okay.
If it's fragmentation for no good reason,
agreed. Then
right?
So that's foolish.
That's foolish. If it's for the investor app, I have an investor app. I haven't seen I've seen one investor app that's okay. So that's why I'm like, look, guys, I'm not going to charge you more for it. Take it. We strive by having a great product that people use, right? So like that's the fight we fight. So you know, and it's true. You know, I don't know if you've seen this chart. This amazing chart around the fragmentation, the universe of wealth tech players. And it's the most complex puzzle, right, that you'll ever think about.
They're players across the value chain.
Across the value chain.
Microservices of not in the sense of microservice, but they're very, very targeted offerings.
Exactly.
Yeah.
Right. And it's a mess. And that's what our thesis is, that like you need someone that constitutes sort of like 70-80% of your tech stack, right? And that we do integrate with other parts where it makes sense, right? But like, sorry, that's sort of like my answer.
All right. So my I've kept here longer than I want to. Last question. What's the next 1 year, 18 months for you guys in Alpheya? Where's the focus? How are you actually balancing two very different environments from a regulatory perspective, maturity perspective between the UAE and let's say Saudi, with being two primary markets. So, where's the focus? You don't have to share the trade secrets, but just to give us a flavor.
No. Look, we are working with folks both in Saudi and the UAE. Biggest difference between those two markets, I assume it's been covered in this podcast to death, is one has cloud for financial services, the other one doesn't.
Yeah, and I didn't even want to bring that up because we've had that conversation several times.
Absolutely, no, and for a cloud native platform deploying on-prem, it's kind of annoying. It's annoying for us, and it's annoying for our clients first and foremost.
It's also expensive, and then 100%. Future agility is a challenge.
100%. We're hopeful that in 2026 we can move everything to the cloud, right? But so we're operating in those two countries where our goal is. Where we should be managing circa $25 billion of assets, administrating, right? By early next year.
Okay.
So that's sort of like, we've incorporated. That's why I say incorporated, not launched last year. So we're fully in build mode, and we're in the process of deploying our platform. It will be fully deployed by Q2, Q3 of next year.
Okay.
Right. It's planned for Q2. We all know that it's going to go into Q3, and like those are the deadlines with our clients, by the way. So for us, it's like, okay, let's roll out the full platform. Right? Integrations are always painful, but we want to do it in like a manner that we look back at it, our clients look back at it, and they're like, well, actually, it went quite okay. So that's sort of like one, right? Deploying and getting the market to talk about how great we've been. Number two, it's going to be deploying and having people experience the change, right? And then number three, it's going to be continuing to work on the pipeline, continuing to grow, and set up the pieces for the upcoming years.
So what's the one biggest risk that concerns you?
The one biggest inertia.
Inertia from the banks?
Yes. That's the biggest one. Because we have a great product. We have what the market needs. We're the only big fintech that has its executive team here. Mm-hmm. When we talk to clients, the CEO talks to the clients, the CTO talks to the clients, the CPO talks. The clients here, they are top priority. They're not the 90th priority, right? So we have a great product. It's like, Arabic enabled, Sharia enabled. It ticks all the boxes. Every client conversation I've been with, even with the most advanced player, they loved it. It's inertia.
Fair enough, and I appreciate that. So, Roger, I appreciate you taking out time. I think we can have another 2 episodes
I would love that.
Topic, because it's a topic of interest to me, and I've spent the better part of the last 12 to 18 months in this particular part of fintech, because to be honest with you, it wasn't front of mind for me for about the first 10, 12 years, where we were still dealing with what I call early stage fintech. It's a fascinating area. Again, I'm not in a position to say what is right or wrong. I think what you guys are trying to do, there is a market for there clearly across the board, whether they're large banks or smaller banks. I think everybody is looking at wealth with, I guess, a renewed impetus. I wish you the very best. I hope you guys get your platform up and running by Q2 and not Q3. and I think that inertia, as long as you understand that inertia is there, is critical. And I think you make a very good point. Being regional, being local, having these clients as top of mind is important, rather than being someone who's coming from a very different part of the world and, wherever you are in the pecking order. Thank you for coming in.
Thank you for having me. Thank you for the dumb questions.
Well, I'm known for dumb questions, so I've lived up to my reputation very well 90 odd episodes later. But I'm sure we'll keep in touch, and I'm sure our paths will cross each other.
Thank you.
Thank you. So, ladies and gentlemen, that was Roger Rouhana, who is the CEO of Alpheya. He's candid about his views, and he was quick at pointing out the few areas he disagrees with me, which is what I love, because I think there's never a good conversation if both people agree. But with that, thank you, and I'll see you guys next week. Bye-bye.